Hey, thank you for coming out today in this rainy day. So I'm going to give you the full benefit of the presentation, even though we have a very small audience. Otherwise, I would just sit down and chat with you and answer any specific questions you have. But any questions that you do have, I want you to feel free and encouraged to ask me what those questions are. So the whole idea of optimization of Social Security is something that is of very, very keen interest to me, and you'll know in a moment why and how I arrived at the point where I wanted to do more public outreach to help people optimize Social Security. Women are particularly adversely affected by a number of areas and more, generally speaking, more reliant upon Social Security for three main factors. Number one, many women leave the workforce to raise a family, go to school, so they have some zeros on their earnings record. The second thing is that on average, women's retirement nest egg is smaller than most men of comparable age who worked in comparable occupations. And in fact, women today are still only paid 83 cents to the dollar for comparable work. That is, a man doing the exact same work, women are only paid. Now, it used to be like 65 cents, so there's been progress made, but still women are underpaid relative to men working the identical positions. But the third reason is, too, and you all know this, is that women on average in the United States and other countries as well live longer. In the US, women live an average of 3 years longer than do men. So for that reason, I think Social Security optimization is much more crucial for women than even for men. Not that all couldn't benefit. And again, what I'll do is I will share with you, I want to give away a couple of these little cups here. Anyone know who this Ludlow lady is here? Any guesses? So if you look closely, you'll see that she is at her mailbox, or post box right there, and she's holding a Social Security check.
Number one.
She's number one. Ida Mae Fuller. Now, Ida Mae Fuller was from Ludlow, but not Ludlow, Massachusetts. She was from Ludlow, Vermont. And so she received the first check for $22.54. She retired in 1939, got her first check in 1940. They only started collecting FICA taxes. That's the Federal Insurance Contributions Act. FICA taxes, which is used to both fund Social Security and Medicare. They only started collecting that in 1937. So she only paid into that system for a little bit less than 3 years. Again, I've read a lot about the history of Social Security, but she received over the course of her lifetime, because she lived in excess of the age 100. She was like 100 and a half or so. She collected $22,880.92. So what Social Security, when it was first passed in August of 1935. Franklin Delano Roosevelt was the president at that time, and there was primarily a Democratic Congress. It was, in the midst of the Great Depression. So it was passed, and it was intended to do a number of things. It provided some old age assistance for people that generally in the United States, as a result of the Great Depression, were indigent. That is, they didn't have sufficient monies to pay their bills. So that was a component, but they put in place old age retirement, which is what most people receive today. They put in place survivor benefits, that is for individuals whose spouses had passed away or whose, let's say, parents had passed away and they were a young child. And they put in place disability insurance as well, too. So this is who I am. I am next month to be precise, I will have been in the financial services industry for 44 years. I started out with the firm of Kidder Peabody and Company in downtown Springfield. I currently work with a Boston-based financial advisory firm, and I'm the director of client engagement and content curator. Content curator is a fancy word for I do a lot of research and we're on the public face of our small company, our financial advisory company, and I go out. I've earned a number of credentials in the past, one of which I'm considered a chartered alternative investment analyst. You have to take a series of 5-hour examinations to pass it. It's not something you can buy. You have to study for and earn and pass these exams. I'm firmly committed to the fiduciary standard. A financial fiduciary has to put their client's interests first. And I have been licensed as a broker. I started off, as I said, with Kidder Peabody in March of 1981 is when I started in the industry. So I've been in the industry a long time. I always did not have the role as a fiduciary, but I took subsequent licensing. So now I have to put clients' interests first, and I think that's the way it should be anyway. I'm a Social Security recipient. I'm also on Medicare, and I currently live in Newbury, Massachusetts, but, and I was talking about this earlier, I previously was the state representative for East Long Meadow, Massachusetts. I was elected in 1976 to the Massachusetts General Court. I represented East Long Meadow for 2 years, and then they changed my district because I was very much a maverick. And so they redistricted, took away 60% of my district. I lived in East Forest Park, and they put my new district with Wilbraham. So I served 2 terms. One, I represented East Long Meadow my first term. My second term, I represented 2 neighborhoods in Springfield, 16 acres in East Forest Park and Wilbraham. So I really, really feel honored and blessed to have had that opportunity. It was something that I still today thank the people of East Long Meadow, Springfield, and Wilbraham for giving me the opportunity. I have a lot of content to cover. My sense is right now this presentation usually lasts somewhere in the neighborhood of an hour, 60 minutes. It can go as long as 75 if people have questions, if there's a lot of give and takes. But this is something that I'd like to ask your help on to give me a sense of what is more likely applicable for your own situations. So, how many people here have already claimed their Social Security? So all of us have, okay. And I will tell you, the ideal time to optimize Social Security is before you claim it. There are a number of things you can do after the fact, after you've claimed, but in terms of optimization, getting the maximum benefit for as long a period as you live, ideally that's done before you claim your Social Security. So I know already the gentleman back here have family members who have been public employees, right? Is anyone else, have they or their spouse been a public employee? One of the things that was passed on January 5th of this year is the Social Security Fairness Act. It was signed by President Biden. So if you haven't or a spouse has not contacted Social Security yet, although they're saying, hey, we're going to automatically adjust your benefits, I would not leave that to chance. Although I worked for the Massachusetts Department of Mental Health, and then I was in the state legislature for 4 years. I decided to go directly to my Social Security office, directly rather than to wait. My Social Security office is in Haverhill, Massachusetts, because again, I live in Newbury. I live in northeastern part of the state. I don't live in Western Mass any longer. What's the primary reason that you all came today? Yeah. So let's go. I'll talk about some of these Social Security myths a little bit later on, because there are many, many common myths. Such as that you must claim Social Security at a specific age. No, you don't have to. There's generally 3 major ages at which you claim Social Security. There's the minimum benefit age, which is age 62. There's the full retirement age. For myself, born in 1952, my full retirement age was 66, not 65. And then today, anyone born after 1960, their full retirement age is 67. So that's your, and I'll talk about this in a moment, that's your full benefit age. But ideally, what you do to optimize is you hold off and you wait to age 70. Because if you wait for years past your full retirement age, you get an 8% bonus for each year that you wait, but that ends at age 70. So there's no advantage to not claiming Social Security after you've reached the age of 70. So, again, I told you that I have a fairly broad agenda, if you will. I'll just jump right into it. I told you earlier, one of the things that honestly shocked me was that only 4% of Americans optimize their Social Security selection and claiming. Only 4%. 96% of the people don't. Now, you might say, well, Rick, where'd you get that statistic? How did you find that out? I read an academic study that was done and completed in 2019, so a couple of years ago, 5 years ago. And what they did is they looked at a big data set that's been around for decades of 20,000 Americans, and then they pulled out of that 2,000 people who were Social Security recipients. And then what they did was they looked at those people's ages, they asked them health questions, they asked them their other sources of income for retirement, they asked them their work status. When I say they, the academic researchers, it was a team of several individuals, they ran 486,000 calculations, almost 500,000 calculations on each one of those 2,000 individuals. So that's how when they say that only 4% of Americans optimize, this is a result of an extensive study. And again, it was shocking to me, and I felt if that few Americans, less than my 5 fingers, are optimizing Social Security, it means that there's not sufficient information out in the marketplace and the public today. So the impact of that, you would say, well, what's the difference if I optimize my Social Security benefit or not? Is it a big deal? Well, yes, it is a big deal. The reason being, over the course of a lifetime, so let's say you retired at 65, 66, 67, whatever your retirement age, if you're going to live as a man generally somewhere in the neighborhood of about 18, 19 years, that's the average lifespan of a man at age 65, and a woman it's 22 years, again, starting from age 65. The longer you live, actually, the longer you're expected to live on your actuarial tables. So over the course of your lifetime, if you don't optimize, it means that you're leaving unclaimed on the table $110,000 of household income. That's a lot of money. That's a whole lot of money. So there's a compelling reason to understand the ins and outs of Social Security and knowing when to, at certain times, you want to contact the Social Security office because there are changes to the law made. And you want to make sure that your benefit statement, your earnings record, and or your spouse's, if you're claiming on your spouse, is as accurate as it could possibly be. So there are a number of factors that you take into account before you claim Social Security, right? In terms of, the first one is if you need income. I said the minimum benefit age is age 62. You might decide to claim earlier than the optimal time. Understandably, if you're in poor health or your spouse is in poor health, that might be a reason for you to claim earlier and not fully optimize your benefit. There are certainly legitimate reasons. You want to look at the age difference between a spouse. You know, if the age difference, I mentioned earlier, I'm a widower. The difference between myself and my wife, who passed away about 5 years ago, was only about 18 months. But if there's 5, 6, 7 years age difference in the spouse, either way, the wife is older than the husband or vice versa, you want to take that into account in factoring. Is there a history of longevity in your family? You want to have that. Your marriage status is very, very important. You can only claim benefits on a spouse if you were married for 10 years or longer, but there is an exception to that rule. If you marry after age 60, you only have to be married for a year. And again, your health status. So there are a number of factors that you take into account. I already mentioned this, so I won't spend much time, but because women earn on average only 83 or 84 cents of the dollar for a man, over a lifetime, over a career, that means women earn $400,000 less than a male counterpart over 40 years. Very, very big difference. And that's one of the reasons, again, on average, women have smaller retirement nest eggs. Now, are there women who are billionaires? Of course there are, right? But on average, I'm talking about the average American woman, on average, they have smaller retirement nest eggs, they have smaller personal savings, and they live longer. So what are some of the essentials? And again, some of these I did not know until after I claimed my Social Security benefit, all right? I told you I'm a Social Security recipient. Your full benefit is something that the Social Security Administration uses a bunch of acronyms. A primary insurance amount, a PIA, an acronym that's used often, is the amount you're entitled to at your full retirement age. On this graph here, it's showing someone's full retirement age is 67. So at age 67, this individual, a hypothetical individual, would be paid $2,119 per month. I'll show you in a moment what the average Social Security check is and what the highest Social Security check is. But that is the primary insurance amount. This is what you receive at your full retirement age. If you claim Social Security earlier at age 62, you don't get the full primary insurance amount. You get less. You get a discount. Again, it depends upon your age, depends upon what year you claim, but you get a discount anywhere between 25 to 30%. That is 25 to 30% less if you claim before your full retirement age. Today, the full retirement age, mine, again, I was born in 1952, full retirement age for myself and people born the same year was 66. The full retirement age, if you were born after 1960, is 67. So I have two sons. My sons and my son's spouse, their full retirement age claiming is a year later than mine because of a change made in 1983. When President Reagan was president, they made a major change and they gradually increased the retirement age from age 65 up to 67. They did that over decades. Now, this is, just mentioned to you, and this shows it in a different way. If your full retirement age, if your birth year was 1954 or earlier, again, I said I'm 50, 1952 is when I was born with my twin brother. If I claimed at 62, I claimed later than that, but if I did, I would have only received 75% of that primary insurance amount. Whereas, if I held off to age 70, I would get 8% per year for age 67, 68, 69, and 70. So I would get 132% of that primary insurance amount. There's a bonus if you wait. That is for someone, again, whose full retirement age was 66. If your full retirement age today is 67, because you were born in 1960 or later, again, looking at our audience today, I don't see any folks here that or maybe the gentleman filming me today is born after 1960, possibly. But you would get, again, the 8% per year bonus, so it's 124%, because look, the difference in the age. Full retirement age here, 67, full retirement age above. But here's, again, a shocking thing. I told you already that I'm the former state representative from Springfield. MassMutual used to be in my state representative district. MassMutual has been doing a survey the last 10 years. It's a Social Security quiz. They have found, and again, I find this very surprising, but they have found 45% of people nearing retirement age from age 55 to 65 do not know their full retirement age. That is, they might be claiming at 65 thinking, oh, I can claim at 65. Well, no, not if you were born in 1952 or not if you were born in 1960 or 1970. You can't claim your full benefit at age 65. You can't claim your full benefit, again, depending upon your year of birth, until age 66 or 67, again, depending upon when you were born. So there are three, I mentioned this earlier, but I think it's very, very important. Now, again, it may not apply to you. Everybody here has already started receiving Social Security check. But friends, children, grandchildren, whatever, the people that you know, they should know that if you claim at age 62, can you do that? Yes, but you're going to get the minimum benefit. You're going to get that discount. You're going to get that 25% discount here, 30% discount. So if you were supposed to get $1,000 a month, you'd only get $700 a month, right? 30% off of $1,000. So your full benefit age, depending upon when you're born, age is 66, 67, and then the maximum benefit age is age 70. You get that 8% bonus for each year after your full retirement age, but there's no advantage holding off claiming benefits past age 70. You don't get any additional benefits. So if you said, well, I don't really need the money, I'm not going to claim to 75, well, that wouldn't make sense because you're not getting any additional incentive or bonus for delaying. So how do those bonuses come about? Those bonuses are called, another acronym here, it's called DRCs, big fancy word for delayed retirement credits. Delayed retirement credits are the annual bonus, works out to 8% per year for each year you claim after your full retirement age, but again, that ends at age 70. So here's an important consideration. You know, me being a financial advisor for almost 45 years, 44 to be exact next month, but Social Security has the advantage, two really, really compelling advantages. One, it's income for as long as you live. As long as you live, you're going to be able to collect your benefits and or your spouse benefits, your spousal benefits, right? So that's a very, very important consideration to think. It's like an annuity. It's an annuity as long as you live. The second advantage of Social Security is that it has a cost of living adjustment. Actually, Social Security calls it a cost of living allowance. But here is an issue with the cost of living allowance. This here is a chart showing from 2013 through 2025. This year, we all received a 2.5% inflationary adjustment, a cost of living allowance or cost of living adjustment. See in 2023, that increase in 2023 to Social Security was the largest increase like in 40 years. That was because in June of 2022, the inflation rate in the United States was 9.1%. And when they calculated the COLA benefit, the cost of living increase, that's why it was so high in 2023. Now, I will show you, though, an important consideration. There are different consumer price indexes. One of the most widely used consumer price index is called the CPI-W. That's the Consumer Price Index, CPI, wages for urban wage earners. That is what's used to calculate the COLA benefit, the cost of living benefit, is the CPI-W, Consumer Price Index for wages, and that happens to be urban workers. But you know what? Inflation for the elderly is higher than it is for urban workers. There's another CPI index that's been calculated since the mid-1980s. It's called the CPIE, Consumer Price Elderly. The Consumer Price Elderly, if the Social Security Administration were using that to increase our benefits, instead of using the CPI-W, CPI wages, which is what Social Security uses today, we would have received roughly 20% more buying power. We're losing buying power. The reason being is that the elderly cost of living is greater than urban workers. Major reason for that is healthcare, but on average, housing takes a bigger portion out of people's fixed income budgets. So on average, elderly, people 65 and older, have a higher rate of inflation than do urban workers. All of us have an incredible rate of inflation right now in eggs. I know that, you know. The eggs have increased over, in 4 years' time, eggs have increased over 300%, something more on the order of 350%. So if you haven't done this, I still urge people to do this. Log on online. If you're not that tech savvy, find maybe your spouse is, maybe a child, maybe a sibling is. You should log on to your account. I'll tell you, the last time I logged on my account, it was several months ago. It forced me, Social Security forced me to have a new login. It forced me to log in under login.gov. And what it does is, if you go to your Social Security account right now and want to log in, it might prompt you to do another login. Now, what they do is, to make sure it's you, this login site will ask you credit questions that probably only you know the answer to. It might ask you if you owned a 2004 Hyundai or a 2016 Lexus. It's going to ask you kinds of questions. Then in all likelihood, only you would know that. It might ask you former addresses that you have. But what they're doing is, my sense is, I haven't called up Social Security and say, hey, why'd you guys force me to do a new login? My sense is it's a more secure site. So again, if you were to go in, I would say, ordinarily, I'm suspicious and skeptical of, hey, should I log in, or is this a phishing attempt trying to get information? If it forces you to do that, it's legitimate. So let's talk about some Social Security rules, regulations, and requirements. So this wouldn't affect you all today unless you were working. But if you work and you collect Social Security before your full retirement age, Social Security takes away some of your benefits. So let's say I'm going to make a scenario here. Rick Roach, myself, let's say that I decided to start collecting my benefits at age 64 or 65, and my full retirement age was 66, right? And if I earned $50,000 that year that I tried to collect, Social Security is going to take one of every $2 of my benefit away. Now, this has been in place for a long, long time, so this isn't something new. And basically what it does, it would say that if my income, let's say I'm making this up, 2014, my income was $22,320 as a single filer, I would have been subjected, I earned $50,000, I would have actually had my Social Security benefit, should have been in this scenario, $23,112 a year. So if you want to know my monthly amount, just divide by 12. And I would have only received $9,812. You'd be, well, what happened to it? It's because there is, for lack of a better word, a penalty for people, for individual who collect Social Security before their full retirement age. if your full retirement age was 66 or 67, you can work all you want. You could, you could work 80 hours a week and earn $1 million a year. And in that instance, they wouldn't reduce your Social Security benefits. That is provided that you're full retirement age or older. That goes, that in effect, that penalty, if you will, goes away. So here are some relevant questions in terms of when people are trying to optimize Social Security. They'd want to look at whether or not they're going to be able to claim more on their own earnings record, their career earnings, or they're going to earn more by claiming a spousal benefit if they happen to be married. What the Social Security Administration does is they take your 35 highest earning years and they do an average monthly earning you have over that 35-year period, and that is how your Social Security benefit is calculated. They use that. It's a complex formula. I won't go into all the formula, but suffice to say they take 35 years. Now, I have looked at my work record. My first work record, I started paying FICA taxes, federal insurance contribution, in 1967. I worked on beach chair rentals in Atlantic City, New Jersey, where I grew up. So I was subject to, my earnings that year in 1967 was $267 as a 15-year-old, all right? But I paid FICA taxes then. So what they do is they look at your 35 highest earning years. Again, either if you're claiming on your own record or you're claiming on your spouse, it's the same. That's how that formula works. So depending upon your answers, you might be entitled to the benefits that we receive on our own earnings record is called old age insurance. That's what it's called in Social Security language or terminology. Or you might be entitled to a spousal benefit. You might be entitled to, if you're divorced, a divorce spousal benefit, or you might be entitled to a survivor benefit. It all depends upon your own situation that you're in. So it's very, very important, though, to try to coordinate all these. I was on the phone earlier today to a very good friend of mine. He's formerly a firefighter. He will be affected by the bill that was signed by President Biden on January 5th of this year, the Social Security Fairness Act. I may talk a little bit about this at the end. So what I was finding out, and again, this is someone I've known since I've been a teenager. He's been collecting on his own benefit, but because he was a firefighter, he had a reduced Social Security benefit. I told him, his name is Fred Sacco. I said, Fred, you should probably be claiming on your wife Patty's record. You will, in all likelihood, earn more money for a spousal benefit where you can get 50% of a spousal benefit as long as that spouse is still living. If the spouse is deceased, you get 100% of their benefit. But as long as they're living, you get 50% of the benefit, up to 50% of the benefit. So a lot of people don't know this. I know I told you already. I would share with you. Yeah, sure.
Can you collect your benefit plus?
No, but what you can do is this. What let's say you're claiming on your earnings record. The Social Security does use a strategy. It's called topping off. They will look at your spouse's benefit, and you might get an additional boost. But no, you cannot collect on a spouse and your own record at the same time. You can only collect one. But there is a formula where they might add, let's say, roughly 10 or 12% in this topping off. I do have one slide that addresses that. And that's a very, very good question, because a lot of people think, well, I could collect on both. But no, you can't. You can only collect on one. So the average American today, the average worker in the United States, retired worker to be more precise, the average retired worker is receiving $1,976 a month. That's the monthly benefit for all workers. We have 73 million Americans today that are receiving Social Security benefits, 73 million. Now that's some that get disabilities, some have survivors benefits, some are collecting their own record. We have 73 million folks collecting Social Security in America today. And again, that's hot off the press. I get those statistics from the Social Security Administration. But if you are a high wage earner, remember I told you, Social Security, when they calculate your benefit, they look at your 35 highest earning years. If you're a high wage earner, and you were paying the maximum FICA taxes, the Federal Insurance Contributions Act. Today, this year, you could be subject to, as a high wage earner, up to $176,000 of FICA tax. All right, that's the ceiling, and then it stops. So if you made $200,000, you'd be taxed FICA as a high wage earner up to $176,000. All right, but these individuals can get up to $5,108 a month. So look at the difference. Under $2,000 a month for all retired workers, the highest wage earners can get 2.5 times that. That's 150% higher. if you were the highest wage earner. But again, there are people that have paid a lot more money into the system as well too. So there's an element of fairness in that system intentionally built into the Social Security funding mechanism. So I didn't know this, maybe you all did. I didn't know when I would get my Social Security check. So if you were born on the 1st through the 10th of the month, you get your Social Security check on the 2nd Wednesday of the month. I happen to be born on, I was born on February 15th. I have a twin brother, my twin John and I were born, he's 8 minutes older than I. So if you're born on the 11th to the 20th, you'll get your check. My brother and I get our checks deposited in our bank account on the 3rd Wednesday of the month. And if you were born on the 21st, the 31st day of a month, you'll get your Social Security check deposited to your bank in all likelihood. Some people still get paper checks, but a very, very small percentage, or they get a Social Security benefit card sent to them if they didn't have a bank account. So, spousal benefits. Let's talk a little bit about, I'll give you a couple examples here, and then I'll go into survivor benefits as well, too, in terms of this. So, here's an example. This is a hypothetical. The spousal benefit, the maximum you can receive on average, your spouse is still alive, 50% of their benefit. But there are caveats. If you claim before your full retirement age, even if you didn't work, you don't get the full 50%, you get less. But so here, we have Jack and Jill. They've been married for, let's say, 20 years. In order to get a spousal benefit, you have to be married for at least 10, with one exception that I'll cover later on. They're married. Jack's primary insurance amount, that's the full benefit. Remember I showed you what that was? $2,400 per month. Let's say Jill never worked outside the house. Now, I had a mom, I'm one of 7 kids. My mom worked. She didn't always work outside the house, but she worked raising seven children. But she, in this instance, Jill did not work out of the house. She was a non-working spouse. So Jack, the husband, files for his benefit. Jill's benefit would be half of his, provided that she claimed at the full retirement age. So if Jill's full retirement age was 66 or 67, she'd get half. If she started claiming at 62, which she's allowed to, she's not going to get half. She's going to get a discount. That's the way that the claiming in Social Security works. So looking at coordinating benefits, you're going to receive, and this is somewhat, I'll show you in a moment, the topping off strategy. What happened in 2015, Congress passed a new law. It was called the Balanced Budget Act of 2015. They took away something certain people in Social Security were using, for lack of a better word, a loophole in the system. Someone like myself who's married, what could have happened was I could have claimed benefits on my spouse's working record. My spouse did work. I could have claimed and let my benefit grow until age 70. You used to be able to do that. They changed that with the Balanced Budget Act, the United States Congress, in 2015. So effective 2015, they passed the Balanced Budget Act. 2016, it went into effect. Now, if you are entitled to collect on your own work record, your own earnings record, and a spousal benefit, in effect, Social Security makes you file for both at the same time. Technically, they make you file for both. It may not be transparent to you, but that's what they do. It's called deemed filing. And this took effect as a result of that 2015 act by the United States Congress that went into effect, in force, in 2016. What they do is you will get whichever is the higher of the two. You'll get either 50% of your spouse benefit, assuming you claim at full retirement age, or you'll get your benefit, again, your full primary insurance amount, again, but that assumes you're claiming at your full retirement age. Remember, if you claim early, there's a penalty, there's a discount. So this is the deemed filing rule. And again, today, as a result of that Bipartisan Budget Act of 2015 that made changes, if you turn 62 on or after January 2nd, 2016, Social Security, in effect, makes you do this so-called deemed filing. It may not be apparent to you, but that's what they're doing. They're basically, Social Security Administration worker that you're talking to on the phone, that you've seen in the office, or that you've made an application to when they review it, they're looking at both your benefit on your own work record and your spouse's. Now, you're entitled to the higher of the two. Now, this is, I mentioned earlier, because you asked a really, really good question. Can I collect both my benefit and on my spouse record? The answer to that is no. You have to do one or the other. But usually Social Security Administration is going to give you the higher of the two. But what they do have is this. Here's an example for this. Again, a hypothetical. So let's say Jack's primary insurance amount, his full benefit, was $2,400 a month. Jill's primary insurance, his spouse, was only $800. Jack has already claimed the benefit. So Jill files for Social Security at the minimum benefit age. Remember, if her full retirement age was 66, 67, she claims at 62, she's going to suffer a discount, as anyone else would, right? But what they do is they take 1/2 of her spouse's benefit, they reduce it by 35% because she's claiming early. But then what they do is they add back in a little bit of money from her benefit to that. So if she claimed on her own, she'd get $800 at the top line up there. If the Social Security Administration will automatically do this topping off, she would get $820, not half of his benefit. Remember, his benefit's $2,400 a month. Half of that benefit would be $1,200, right? But she claimed early, so she gets a penalty. But the Social Security Administration will automatically do the topping off. Now, if you thought that you had someone that was not attentive, you might want to say, hey, have you looked at any additional benefit for myself as a result of topping off? If you said that on the phone, the Social Security or in your office, they would know what you're talking about to make sure that they checked. So, and again, it's very, very important to coordinate benefits. In the interest of time, I'm going to jump now to divorced spouse. Remember the Mass Mutual study that I told you about? That 45% of Americans today do not know their full retirement age, which again, I have the advantage of having been in financial services for a long time. I knew what my full retirement age was, but it's tragic that so few people do, because what they do is they inadvertently go in, they think, oh, I have to claim at 62 or I have to claim at 65. Well, one, you don't have to claim then. Two, if you do claim and your full retirement age is older than that, you're going to have a discount. That's the way it works. So, but 4 out of 10 ex-spouses do not know that they can claim on their ex-spouse. In fact, I'll talk about a scenario. If there was a gentleman, somebody who was married 4 times. He was married to 3 women, 10 years or a piece on all 3. All his 3 ex-spouses and his current spouse, if they were married for 10 years, could collect on his benefit. It had no effect. They're not going to reduce his. And they're not going to reduce the ex-spouse's benefit. So that actually, when it comes to spousal benefits, the Social Security regs, in my opinion, are somewhat loose, if you will. There's no penalty for multiple marriages. So here's how the divorced spousal benefit works. Basically, it works the same way as a spousal benefit, a divorce benefit. In fact, the woman I live with today, she was married once and divorced. Again, as I told you, I'm a widower. But she actually collects on her divorced spouse's record. So again, I know exactly how this works because the woman in my household in Newbury, Mass., we own our home together, she actually collects on her divorced spouse. So marriage has to last 10 years. You have to be currently unmarried and the ex-spouse at least 62. But if you were divorced for more than 2 years, Cynthia's been divorced for 20 years, the one I live with, they do not have to file their benefit yet. So although she and her husband were comparable in age, she didn't have to wait for her ex-spouse to file. She could file as long as you were divorced more than 2 years ago. That's how the divorced spouse. So again, an example, Dick and Dora are divorced. They were married 10 years. Dora is older and currently unmarried. Her husband, Dick's primary insurance amount, $2,400 a month, and he was over 62. So she's allowed to file a divorced spouse benefit. So she does at her full retirement age. She's going to get 50% of his $2,400. Again, doing the math, $2,400 a month divided by 50 is $1,200 a month that she'd be entitled to. So here, let's say this. I just gave you this scenario. Let's say Dick had several ex-wives, all of whom he was married to 10 years or more. It wouldn't affect any of them. They could all claim on his earnings record, and it doesn't lower his earnings, his Social Security check either. So if you were married 10 years or longer, you're currently unmarried, you're entitled to up to 50% of the spouse primary insurance amount. But again, that assumes you're claiming at your full retirement age. If your full retirement age is 66, 67, and you claim at age 65, you're going to suffer a discount, all right? So again, here's one of the things that I do tell people is that you might, if someone's divorced, they might want, to the extent they can, keep tabs on their ex-spouse, because if the ex-spouse passes away, then you're entitled to not 50% of their benefit. You're entitled to 100% of their benefit. So your check would actually double. So I've told Cynthia to keep tabs of that ex-spouse, his health status. So what about you remarry after the age 50? Well, there's some danger, if you will, traps, if you will. You know, it's interesting. Have you heard the term gray divorce? The divorce rate for people now 59 and greater is 4 times higher than people like 35 to 45. There is a plague, if you will, of gray divorce of people that have decided that they no longer want to be married to their spouse, and they're divorcing after age 59. So that's called gray divorce. But if there are some general rules, I'll just point out one. If you remarry after age 60, you might be eligible for survivor benefits on the deceased spouse or your current spouse. So what you do is this. In that instance, you contact the Social Security office and find out, they know, Social Security Administration knows the earnings record of both of these men, right? I'm going to say men for the example, right? It's same for same-sex marriages as well, too. But I'm going to say they're both men. They know, so you would want to claim on either your ex-spouse or your current spouse, depending upon who had the higher check. You're going to get 50% of their benefit of, assuming, again, they're both alive. If the divorced spouse is deceased, you would get 100% of their monthly check. So I just mentioned this, you know, in Massachusetts, the state passed, I think the same-sex marriages were passed in the Commonwealth of Mass. I think it was 2005. But the Supreme Court in 2015 made same-sex marriage legal throughout the United States. For that reason, same-sex couples have the same advantages as I'll call traditional couples. So, claiming advice by marital status. What you want to do is you want to coordinate your benefits. If you're divorced, you're entitled to the divorced spousal benefit. Claim at your full retirement age. That is, hold off to then if you can. That's the way you optimize your income. If you really, really needed the house income earlier, then I understand you might want to claim earlier than your full retirement age. That would make sense. Coordinate your retirement and survivor benefits. As a widow, I'm a widower, take the higher of the two. Take the higher of on your own earnings record, or take the higher of your, in this instance, a deceased spouse, right? If you're a widow or a widower. Never married, one of the things you'd want to consider is trying to delay claiming, because then you could get that 8% per year bonus after your full retirement age. So let's look at survivor benefits. This is something very important that may not affect anybody right now here in this room, but I know we have an audience looking with us, is that you cannot apply for survivor benefits online. You can apply for your own benefits online. You can apply for spousal benefits online, but you can't apply for survivor benefits. So you need certain things. Of course, you need the deceased, or the death record, if you will. You need proof of your marriage to that person. So you need at least an original copy of your marriage certificate. So there are a number of things that are required. So you have to apply either over the telephone or in person at a Social Security office for survivor benefit, not for spousal, not on your own work record. So here's how survivor benefits work. Survivor benefits are really, there are two major factors. It's when, let's say that deceased spouse, when did he or she actually pass away? When did they first claim? Did they claim their original benefit at their full retirement age, or did they claim it early? If they claim it early, your benefit is going to be lower, all right? And then the second factor that comes into place is when the widow or widower claimed that benefit. That's the actual benefit. And again, I would tell you that if this scenario arose, what you'd want to do is you'd want to wait at least until your full retirement age before you claim it, unless you had an instance where you needed the household income. There are, I told you already, only 4% of Americans optimize their Social Security. Generally speaking, you're better off holding off till later, but that's not always the case. We at Wealth Effects, the company that I work at, have a free service that's called Social Security Planning Analysis. There's no obligation. It gets a very, very small number of demographic facts about yourself, your age, your spouse, their age, their estimated benefits that you could get off your Social Security statement, and it runs an analysis and shows you different claiming strategies. There are literally 500 plus ways to claim Social Security. There are 500 different variations. So it can be very, very complex. So your original survivor benefit is based on when the deceased spouse claimed the benefit and when you claim it. Again, I'm saying here women. Again, I already mentioned this. So in this scenario here, this hypothetical, Jack and Jill married. Jack's full retirement age was 67. He died at age 70. If he claimed his benefit at 70, Jill's survivor benefit would have been based on his. Now, his primary insurance amount was only $2,400 a month, right? But because he held off to age 70, he got a bonus. He got 8% for 3 years. 8% times 3, of course, is 24. So the surviving spouse, the survivor in this instance, would get a greater amount by holding off. If, on the other hand, the deceased spouse had claimed his benefit at 62, she'd only get $1,980, not $2,100. And again, you might think, well, what's the difference? Well, that's more than $12,000 a year. That's the difference. It's more than $1,000 a month. That's a big difference. So here's one final example here. What I looked at was, I looked at a scenario with Jack and Jill, okay? Jill, in this instance, she applies for a survivor benefit at age 60. And Jack, the deceased husband, claimed his benefit at age 62. You can apply at that age 60. I said there's certain, generally the claiming age is 62. You can apply earlier as a survivor, all right? So if she did that and the deceased spouse claims 62, she's going to receive $1,716 a month if she did this instead. If Jack didn't claim to age 70, he held off, all right? Jack claimed at age 70, let's say he died at 73, 74, whatever the age was, and his spouse did not claim to her full retirement age, she would get $2,976 a month instead of $1,716. Look at the difference in that. On a yearly basis, it's $15,000. It's a big, big difference. So again, this shows you how there's two factors there, the original benefit and when the surviving spouse claims. They're the two factors that decide it. So they can be claimed, survivor benefits can be claimed at age 60. And if disabled, there's a potential to assume, to claim that benefit at even an earlier age. So I'm just looking at my clock here in the interest of time. So what if you qualify for both a retirement benefit on your own earnings record, your own work record, and a survivor benefit? What you want to do is, there are more switching opportunities. Again, I told you I had a conversation with a friend of mine today, a lifelong friend. I told him he's claiming right now on his Social Security record, but he was a firefighter. And firefighters for many, many years did not pay into the Social Security system. His wife's Social Security check, her monthly check, is 5 times greater than his. He's getting $191 a month. I said, Fred, you should be claiming on, his wife's name's Patty, on Patty's record. You'll get half of her benefit. Now, his wife is still surviving. She's not deceased, but he will get 5 times as much money by claiming on his living spouse record. So it's a matter of switching opportunities. There are more switching opportunities available, generally speaking, with survivor than spousal. But it's something that you should be aware of. And you should not think, okay, well, I claimed Social Security once, I'm never going to contact them again. No, you should. I was in my own Social Security office in Haverhill, Massachusetts, about 3 or 4 weeks ago. So I will tell you that even though I've been claiming, for a number of years, I'm 73 now, I've been claiming for a number of years, I'm not going to just allow that to sit there without making sure that I'm getting the maximum benefit that I'm entitled to. I and my former employers paid hundreds of thousands of dollars into the system, and I want to make sure that I'm getting my accurate amount. So let's just do this. I'll give you one more here. Claim a survivor benefit at age 60, claim the retirement benefit 70. This is called switching. You're switching, you're going from claiming on one thing, your own benefit, your own work history at age 60, and in this instance, she's claiming, the survivor benefit, because her spouse is deceased. She's claiming at age 60. But what she's doing is she's allowing, she worked in this scenario, she worked, and if she waits past her full retirement age, she's going to get 8% per year for every year after her full retirement age. So what she'll do is, during this instance, her primary insurance amount's $2,000 a month. Her survivor benefit would have been, so her deceased husband was getting $1,800 a month. She gets 100% of his benefit because he's deceased, right? It's a survivor benefit, it's not a spousal. And then what she would do is she would switch. She would allow her benefit to increase that 8% per year for 3 years, because she full retirement age was 67. She would get $2,480. So instead of getting only $1,800 a month, she's getting $2,400 a month, almost $500 a month more. So one of the final things in this section here is looking at the health of your spouse. To the extent you, generally speaking, to optimize, you want whoever is the highest earner in the household to delay to age 70 ideally, so that, because you're expected to receive these monies for decades, right? If you're going to live in retirement 20, 25, 30 years, it pays for you to wait for those benefits. So, coming down the final stretch here. This is something, a very, very candid admission by the Social Security Administrator under President Biden, who stepped down as a result of the new administration, right? His name is Martin O'Malley. Martin O'Malley used to be the governor of Maryland, and he was the administrator for the Social Security Administration. Social Security Administration is based in Baltimore, Maryland. I think O'Malley may have been the mayor of Baltimore, too. I'm not sure of that, but I know he's governor. So that is Martin O'Malley there. Last June of 2024, Martin O'Malley admitted that 30,000 Americans were waiting for decisions from the Social Security, and the Social Security did not get back to them with a decision, and these individuals had actually passed away. 30,000 people passed away before receiving notification. Now, maybe not all their appeals would have been successful, right? But it's the Social Security Administration today, as we sit here today, has the lowest staffing they've had in 25 years. They've been closing Social Security offices, which I think is a huge, huge mistake. And they basically, you know why I'm talking about optimization? The reason I'm sharing this with you is the Social Security person you talk to on the telephone is not allowed to tell you how to optimize. They're not permitted to do that. They can tell you what you're going to get if you're making a claim on an application at that time. And you could say, well, I want to look at either my benefit or my spousal. But they can't tell you, oh, wait a minute, you're 65, you should hold off to your 67. They're not allowed. And you know what? In fairness to them, they don't even have the time to do that because they are understaffed and overworked. And again, I don't work for the Social Security Administration. I work for Wealth Effects LLC, a financial advisor firm in Boston, Massachusetts. So I'm not an apologist for them. But one, they don't have the time, the resources, or even the permission, if you will. They're not allowed to tell you how to optimize. So how do you optimize? One of the tools, and if anyone wants us to run this for you, we will. We have a no-obligation tool at Wealth Effects. It's called the Social Security Planning Analysis. Basically, it takes some very, very basic demographic information. Your age, how long you worked, your estimated benefits that you get from Social Security, and your spousal, again, certain demographic thing. And then it gives you a number of different scenarios. So basically, it will give you at least 5 different claiming scenarios. So again, this assumes that the person has not claimed yet, all right? But it could look at both of a couple claiming early, number one. It could look at both of a couple claiming at their full retirement age, with John and Jane. This was John and Jane Doe. Again, this is a hypothetical I ran. Both could claim later than their full retirement age and get that annual 8% bump, which would mean they'd get more money. So like here, they both claim early, they'd get $1.5 million. If they both claimed at their full retirement age, they'd get $1.6 million. Here, they'd get almost 1.7 and 1.78 if they both claimed later. So it runs a number of scenarios, basically telling you these are a couple of the options that you have, and then what you do is you direct to Social Security, say, okay, we both want to claim early, we both want to claim late. One of us wants to claim early, one of us wants to claim late. It does that kind of analysis for you. It's we think, a very, very important tool. This is a strategy here. It's called the Social Security split strategy. Basically what it does is it looks at Sharon, the wife here, Ken, her husband, and Sharon filing for her benefit at full retirement age. And then what she's going to do at age 70, she's going to switch over to her spousal benefits. Why? Because her spousal benefits would have been higher than hers. So what you can do is you're not necessarily, a lot of people think, well, I said there was myths earlier. A lot of people think once you make a decision for Social Security, it's set in concrete. It's not. There are certain switching strategies available both to spouses and more particularly to survivors. So I think it's important to stay on top of that. And these are the two things. Again, it's a myth that once you claim Social Security, it's irrevocable. That is a myth. That is not correct. You can actually claim for Social Security within the first year, and you can call up or contact Social Security and say, I don't want my benefits after all, right now. Why would you do that? Because you want that 8% bonus to start. But what you have to do if you do that, you have to pay back whatever you receive from Social Security. You can only do that within the first 12 months after you claim. But there's another strategy. It's called voluntary suspension. And basically what you do is, here, I think I have it here. Basically what you do, and I was chatting with someone about this yesterday in Ludlow. I did the same presentation in Ludlow. This individual, he's claimed Social Security. And again, we're going to do a follow-up discussion. What he's going to do is, he's not his full retirement age. This individual was 65 years of age. His name is David. So David is he's going to suspend his benefit. He's going to then not claim it again to age 70. So if he's 65, why is he going to do this? Because his full retirement age is 67. So he's not even getting his full primary insurance amount. But if he holds off to age 70, he'll get an 8% bonus at age 68, 8% at 69, 8% at age 70. So there are a number of different strategies that you can use, so people should be aware of those. So, yeah.
On that last,
Yeah, sure.
does he have to do that suspension within the first 12 months also?
No, you don't. No. And in fact, you know what? In this scenario here, I assume that Jorge, right? Jorge in this instance is suspending and then holds off to 70. He could suspend at age, let's say started claiming at 65. He could suspend at age 66 or 67, wait 2 years, and then he could decide that, you know what, I don't have enough income to live on after all, and claim it back at 69. You're not locked in to that. So that's much more flexible, this. Unlike if you claim your benefits and then you want to hold off altogether, then what you're going to do is you are required to pay back Social Security, whatever you receive in that first 12 months. You don't have to pay them interest on that money. So if you're looking for an interest-free loan, it might work for you. But again, you know what I would tell people? You have to do the analysis. And so one of the people say, well, Rick, you're suggesting to me that I should hold off on my benefits. I should hold off to age 70. But if I'm going to do that, how long does it take me to break even? If I'm not collecting my benefits, my full benefits, let's say for me, it was age 66. If I'm not collecting my full benefits at 66, I'm waiting to age 70, I'm foregoing 48 months of benefits, right? I'm foregoing to get that 8% per year bonus. So basically, what we can do in this, when I told you that Social Security planning analysis, we can run for you a break even. A break even is the number of years you have to live to that you got further ahead by this strategy. So in this instance, you're taking a chance. You could be in downtown Springfield hit by a bus, and your Social Security check is going to come to an end on your work record. Your spouse might be able to claim. It's going to come to an end on yours. So my final couple minutes here. How many of you currently pay taxes on your Social Security benefits? Do you know? I do as well, all right? And here's how it works. What happens is the Social Security uses a formula. This is married filing jointly. If your household income is $32,000 a year or less, you're not taxed on your Social Security benefits. That's for married filing jointly. Single taxpayers, other taxpayers, $25,000 a year. If it's $25,000 or less, you're not taxed on your Social Security. However, if your household income, you're married filing jointly, is $32,000, $44,000 a year, up to 50% of your benefit could be taxed. It doesn't mean, it could be 37%. It might be 41, but up to.
Does that include your Social Security?
Yes, it does. And it does. What they basically do is they take your Social Security and add back 50% in that income bracket. And if you're in this income bracket, if you're in $44,000 or more, joint filers, then they add in up to 85% of it can be taxed.
Just earned income.
No, your total household income. Your total, and in fact, what they do is many people buy municipal bonds in Massachusetts and other states because the interest is tax-free. Not so with this formula. They use something, it's called provisional income. What they do is they look at your adjusted gross income and they modify it. They being Social Security, and basically it's the Internal Revenue Service. And basically what they do is they modify by adding in any, so if you owned a foreign bond fund, I realize a lot of people don't own foreign bond funds, but if you did and it gave you money, they add that back in. Even if it was so-called untaxed, it was tax-free, the IRS adds it back in. They add in your tax-exempt interest. So if you owned Town of East Long Meadow bonds or Commonwealth of Massachusetts general construction, general purpose bonds, they would take the interest you have and add that back in. So up to 85% of it could be taxed. Now here's something important too, is someone like myself, a financial advisor, they have not adjusted these brackets since 1983. This was passed when President Reagan was president. The so-called, it was the Greenspan Commission. Alan Greenspan headed up, and that's when they raised the age to receive Social Security, and they lowered benefits as a practical matter by raising the age, but then they instituted these taxes to increase the solvency of the Social Security Trust Fund. So they have not been adjusted at all. So there are, you know what, and again, I know this is from Social Security, 40% of Americans, including several here in this room, have our Social Security benefits taxed, 40% of Americans. So it's something that we could conceivably help you do. So in the interest of time, what I'm going to do is I'm going to suggest that if someone, as a follow-up after, there's no obligation obviously coming to this workshop today, but if you want to find several ways that you could conceivably lower the taxes on your retirement income. When I use the word retirement income, I mean it in a broader sense. I mean Social Security and other sources of income that you have. There are a number of proven strategies to do it. I won't go through this in per individual 9 bullet points because some of it's fairly complex. But the point I'm trying to make is if you think that you're in a tax situation where you could potentially lower your tax on your income, then we would offer a free, no obligation consultation on that, because there are a number of ways in which you can lower your taxes. If it doesn't necessarily lower it on Social Security, it might lower it on other sources of retirement income. So I want to offer that to you all here. And then what I'll do is I will, here, let's see. This is the Social Security Fairness Act. Congressman Richie Neal was a co-sponsor of this, as was our 2 senators, Warren and Markey. And it was signed into law on January 5th. What it did was it repealed 2 provisions that were passed in 1983. It repealed what was called the Government Pension Offset, the GPO, and the Windfall Elimination Provision, the WEP. 3.2 million Americans were affected by this when it was put in place in 1983. So this has been in place for 4 decades. But in Massachusetts, Senator Ed Markey says there are 130,000 people in the Commonwealth of Mass that are affected by this. And what I would tell you on this, if you or a spouse had worked as a public employee, the Social Security Administration is saying right now, hold off, we'll automatically adjust you. I would say I would not trust that. And again, I don't have an inherent distrust of government or Social Security. I would tell you that the squeaky wheel always gets the oil. If I were in this situation or scenario, either myself or my spouse, again, I've already told you, my spouse is deceased, if I were in this scenario where one of the two of us had worked as a public employee, as a firefighter, as a teacher, for city, state, county record, I would be at my Social Security office tomorrow morning in person, showing up and saying, I want to make sure you look at my benefits and take me as a priority. Why? Because I took the effort to come on in and see you today. That's why. So I would not leave it up to the Social Security Administration to make sure that your earnings record and what you're entitled to is on target and delivered to you quickly. So that is the end of my presentation here. I would tell you that I think of Social Security as the Swiss Army knife of financial sources because it's guaranteed for life. It will last as long as you live and or your spouse lives. It's inflation protected because we have this cost of living adjustment. And I think it's a very, very important and valuable source of retirement income for all Americans. So I went a little bit past an hour, but I'm available if you have any questions. I have business cards here as well. And if you have any personal questions you want to ask me, feel free to stick around for a little bit, and I'll do my best to answer those. And if I don't know the answer off the top of my head, I'll circle back to you if you give me your telephone number. So thank you for coming.